Welcome back, everyone. Are you looking for a boring company that has historically crushed the market, all the while paying a growing passive income stream? Sure you are. I mean, who isn't? Boring stocks that crush the market are the best stocks to own. The boring company I want to talk about today is Zoetis, ticker symbol ZTS. They are a pharmaceutical business that caters to animal health. The company went public on February 1st, 2013, and today is valued at $72 billion. Since 2013, Zoetis has achieved a remarkable compound annual growth rate of over 18%, nearly 6% faster than the S&P 500. They also happen to be a dividend growth stock with a pretty strong track record of increasing their dividends. The stock is up just shy of 7% year to date, but since September 1st, the share price has fallen by a little more than 18%, putting them on my radar. Let's dig into the business to figure out if it passes my quality test, and to see whether or not it's attractively valued today. I ran the stock through my company analyzer tool a few days ago, and it performed quite well with an 84% overall quality score and a 96% dividend score. Let me break this down for you. The overall quality score is comprised of 4 financial metrics I believe can help me identify quality businesses. The first metric is the return on capital employed, and here Zoetis received a score of 94%. During the past decade, Zoetis has seen its ROC improve from about 16% in 2013 to a little more than 25% today. There were some fluctuations from year to year, but overall, the ROC has trended quite nicely, and a return above 20% is what I am personally looking for. The second metric I test is total revenue, and here Zoetis received a score of 78%. Revenue has grown year over year during the last decade, with the exception of 2015, where we saw a small pullback compared to the prior year. In general, Zoetis has a good track record of growing its top-line revenue, albeit the growth has been below average during some years, and for that they were dinged a few percentage points. The third metric is the gross margin, and here Zoetis received a very nice score of 97%. The company has a very healthy gross margin ratio that has not fallen below 60% during the last decade. Matter of fact, the gross margin has actually trended higher from about 62% in 2013 to a little more than 70% today. A gross margin above 50% is pretty solid in my opinion. And the fourth and final metric is the free cash flow conversion ratio. And here, Zoetis received just an average score of 67%. While the conversion ratios for the last decade looked pretty great, it's the 2023 figure that's a bit worrisome. Between 2013 and 2022, Zoetis consistently saw a conversion ratio above 70%, with most years actually being much higher. But in 2023, the free cash flow conversion ratio came in at a low 1.74%. Granted, the year isn't over, and this figure may still improve, but this low ratio is a bit troubling. Nevertheless, combining the scores from all 4 financial metrics gives us an overall quality score of 84%, placing Zoetis amongst the best ranked stocks I have looked at thus far. Let's now break down the very high 96% dividend score. Since its IPO, Zoetis has consistently paid and increased its dividend, with the annual growth rates never falling below double digits. Now that's quite impressive. If we look at the 3, 5, and 10-year dividend growth rates, they all clock in above 20%. These are phenomenal long-term dividend growth rates that are not easy to achieve. Zoetis received the perfect 100% score for its dividend growth history. In the payout ratio department, the company looks very healthy as well. We did have a minor blimp in 2015, with the payout ratio creeping up to nearly 50%, but otherwise, the payout ratio has remained below 30% during the last decade. More recently, it has trended a little higher, from the low to mid 20% range, closer to 30%, albeit still a very healthy level that leaves plenty of room for future dividend growth. The payout ratio quality score for Zoetis was 92%, which combined with the perfect dividend growth score gets us to an overall dividend score of 96%. So the company appears to be of high quality, and it has a very good dividend growth history with a healthy payout ratio. But let's take a quick look at its current valuation to see if the stock is attractive today. I like to use a blend of the PE multiple and dividend yield theory to help me value stocks. The price from my company analyzer tool of $163.67 is a few days old. Today the stock trades for $157, giving us a slightly more attractive entry point. At the time I ran my stock report, the fair price for Zoetis came in right around $203, suggesting the stock was about 19% undervalued. Based on today's price, that undervaluation is closer to 23%. Let me break down each valuation for you. During the last 5 years, Zoetis has traded for around 39 times earnings. Today, its PE ratio sits at 34.38, implying a fair price of about $185. So the PE multiple is suggesting the stock is about 15% undervalued. Let's take a look at dividend yield theory. Zoetis has a 5-year trailing average dividend yield of 0.65%, and its dividend yield at the time of my stock report was 0.89%, which gave us a fair price of about $222. So dividend yield theory is suggesting the stock is about 29% undervalued. If we average both fair prices out, we come to a combined undervaluation of about 23%. I don't know if Zoetis is near its bottom today, or if it will continue to fall further, but in my opinion, the stock looks pretty attractive. I have a long position in the stock, and I have added to my shares recently, and may continue to do so in the coming weeks. This isn't a dividend stock for everyone, especially if you're seeking an attractive dividend yield. But if you're looking for a dividend growth machine that historically crushed the market, it may be worth putting Zoetis on your watch list. The company is set to announce their Q3 earnings on November 2nd, and they have a pretty good track record of beating analyst expectations. I should note that there have been some down revisions for the upcoming earnings, and during the Q2 investor presentation back in August, Zoetis did lower their guidance. Should they miss on earnings or top-line revenue, that should only present us with an even better entry point. I hope you enjoyed the analysis. If you did, please do me a favor, give this video a like and subscribe to the channel. Thank you for watching and see you next time.